Hello friends, welcome to this video on NISM-Series-XXI-B, which is about Portfolio Manager Certification Examination. And in this particular video, I will take you through the chapter 20 of the book, which is related to portfolio rebalancing. So you will come across a series of questions which are in form of multiple choice questions. Which are related to portfolio rebalancing. We have two sets of questions which I have designed for this particular video. One is the theoretical, and the second, we also have some numerical questions which are created in this particular video or added in this particular video. Now I personally feel that if you go through this video, you will be able to solve most of the questions related to this particular chapter. Still, I would suggest that you please read this chapter in detail, right? So let us start by looking at the first question, which is which of the following is our challenges related to portfolio rebalancing? So we know that fund managers or portfolio managers rebalance the portfolio periodically. The reasons could be many. It could be because of issues related to change in the investment goals, and it could also be because of the time factor and multiple other reasons, right? So which of the following are the challenges related to portfolio rebalancing? Is it so easy to do portfolio rebalancing or not, right? So challenges that we may face, we have listed down as options, and we will evaluate each one of them to see which one is true. So portfolio manager sells appreciated assets and buys depreciated assets. That's what has to be done if you typically follow some of the strategies like constant mix strategy or strategies such as CPPI, which we will discuss going ahead, right? So typically portfolio manager will sell the appreciated assets because of the reason of first rebalancing it, and second also making some money out of it. And the moment you sell appreciated asset and buy depreciated assets, you will have to pay tax on the gains that you have made by selling appreciated assets. So there is a capital gain applicable. So this statement is correct. Rebalancing results into increased cost of transaction, which is also correct because you have to buy and sell, and buy and sell means you will have to pay brokerage. Illiquid assets like private equity or direct real estate pose more complications in rebalancing than listed equity, which is true because if you have to sell a real estate, the costs are very high, time frame is longer. So as a result of this, the answer that we are selecting here, or the answer that we are going ahead with, is D, all of the above. We now move on to question 2. Which of the following is our types of rebalancing? So rebalancing can happen because of multiple factors. First is very simple. You may decide to rebalance a portfolio after every 1 year or after every 6 months or after every 2 years. It's like how you follow the strategy or what are the laws of the land that will define time-based rebalancing. The second thing, you can also do threshold-based rebalancing. So if you have a, say, portfolio in which you have equity and debt and you have kept a 60% threshold for equity, the moment the threshold goes up, the investment goes up to 70%, you do rebalancing. So that's a trigger, right? So the answer is you can do time-based rebalancing and you can also do threshold-based rebalancing. So the answer is A and B. We quickly move on to question 3, which is also asking which of the following is not true about threshold based. So we just understood the concept of threshold based rebalancing. Now we'll see what is not true. So threshold based rebalancing permits tighter control of asset mix compared with time balancing. Yes, that is true. Why? Because time balancing can happen only periodically, while threshold based rebalancing can happen whenever you have a trigger for that, right? So if the equity value has gone up from 60% to 70%, you may like to bring it back to 60%. It requires setting trigger points, we have already discussed. Rebalancing of portfolio can happen on a specific date only in threshold based rebalancing. No, threshold based rebalancing has no sensitivity to dates. Okay, threshold based rebalancing requires decision regarding tolerance level, which is also correct. So what is not correct here is C, right? So move on. Let us move on to question 4. Buy and hold is what kind of a strategy? Okay, so it's a strategy which is followed by many entities, pension funds, banks, even portfolio managers do it, and it's a very passive strategy. It's like buying and then forgetting about what you have purchased, literally, right? So buy and hold is a passive strategy of deciding strategic asset allocation mix and then going with the flow, that is doing nothing about it subsequently. So you are not worried about whether I should rebalance my portfolio, how much I should buy, how much I should sell, and all that. Question 5. The benefits of constant mix strategy is that it helps in maintaining market risk exposures as against buy and hold, which is correct. In case of buy and hold, market risk exposures cannot be maintained because it's a passive strategy. So a constant mix will churn the portfolio and help you do this. So the answer here is true. Let us move to question 6, but at this time just a reminder that please do like this video and subscribe to the channel, and please also suggest this to your friends in case you find it to be useful. So which of the following is the present value of desired level of capital protection in context of constant proportion portfolio insurance? So this concept of constant proportion portfolio insurance helps you to insure portfolio value against falling below a particular level. Okay, and the floor is what is below our feet, right, typically. So the floor works out to be that concept which will be helping you to fall below a limit, right? So you are on the floor at all the time. So the answer for this would be floor. And we do have cap, ceiling and corridor as options, but that is something which is typically spoken in context of interest rates only. Then next is the 7th question, which is about how do we calculate the floor. So we need to work on 3 values. What is the risk-free rate? What is the portfolio value of investment which we have? So here the portfolio value of investment should not fall below 500 is what we are saying, and there's a time frame of 5 years. So what do we do is that we take into consideration 500, which is the amount that we are protecting against, and then we find out the PV of this value, which is the present value. And how do we find out the PV? So we know that risk-free rate is 9%, so we will have to divide it by risk-free rate, right? So this divided by the risk-free rate, and our risk-free rate is 9%. So what will we do here? We'll put it as the 9%, right? So percent we have to put with a plus sign, and then we have to put it as 9%, right? So that is what will give us this percentage, and then we raise it to what we call as 5, right? So once we have done this, we'll get a PV, and the PV will be this much, correct? So we have the answer for 7th one. So we go to the 8th one. Constant proportion portfolio insurance is an actively managed rebalancing strategy that allocates wealth between risk-free assets such as government bonds and risky assets, which is absolutely true. You have to use risk-free assets to create a kind of a protection, but you also invest in risky assets. So the answer is true, right? So we've done with 8 questions. We quickly move on to the 9th one. If the portfolio value is 140, the floor value is 110, and multiplier is 3, then the exposure to risky assets should be how much? So we would say, first take portfolio value as 140, and then from this deduct, which is your floor value, 110, and you will end up getting 30. So 30 multiplied by 3 will give you 90. That's how we arrive at it. So we have 9 questions done. Move on to the 10th one, which is a detailed numerical. What do we discuss here? We look at a case which is there in the book also, and which is also typically asked in exam. A PMS manager receives 50 lakhs from a mutual benefit society to be invested in portfolio of equity shares, leaving 5 lakhs in cash. To encash opportune movements in the market, the manager invests the rest amount equally in KLNM, which is like a value of having a value of 500,000 and 750 respectively. The manager would like to maintain the constant proportion strategy while rebalancing the portfolio at regular intervals. What action should the manager take when the prices of these 3 equity shares have changed to 600, 900 and 1200 after 1 year, right? So first statement, 50 lakh is the investment value, which is what it has received. 5 lakh to be kept in cash. So investment amount is 45 lakhs. That's how we have arrived at this amount. Now we have 3 shares, KLNM, okay? Share prices are 500, 1000 and 750. That's what we wrote here, okay? The total amount is 45 lakhs, right? That's what we have seen, that the total investment value is 45. So divided equally 15, 15, 15 lakhs here, okay? Now 500, if you are buying shares of each share of 500 and 15 lakhs is the investment, you will end up having 3,000 shares. Similarly, when the price is 1,000 and you have 15 lakhs to invest, you will end up buying 1,500 shares. And when you have 750 as the initial share price and 15 lakhs to be invested, you will end up buying 2,000 shares, right? So what do we see here? We see here that the fund manager has bought 3,000, 1,500 and 2,000 shares of 3 equity, which is KL and M, with 15 lakhs, 15 lakhs and 15 lakhs each. Now the share prices after 1 year changed to 600, 900 and 1,200, right? That's what we have put here, 600, 900, 1,200. Now when you have invested, or rather you have bought 3,000 shares and price is 600 after 1 year, okay, then your investment value is 18 lakhs, which is nothing but multiplication between the two values. So you can just kind of put a multiplication sign here and achieve it, right? Then you have 1,500 into 900 again 13 lakh 50,000 and 2,000 into 1,200, which is 24 lakhs. So what is the total value of investment? It is 55 lakh 50,000. That's what it is, right? Now 55 lakh 50,000 is the new value of investments. We started with 45 lakhs. Now since it is a strategy in which the amount has to be equally split, we will split the amount as 18 lakh 50,000, 18 lakh 50,000 and 18 lakh 50,000 with the new portfolio value of 55 lakh 50,000. If you divide this by 3, you will get the same value. Now look at this. New investment value is 18 lakhs, but ideally the fund manager should keep 18 lakh 50,000. So he will buy for 50,000 here. The new investment value is 13 lakh 50,000, but it should be 18 lakh 50,000. So we will again buy, but here the new portfolio value is 24 lakhs, but it should be 18 lakh 50,000. So he will sell. So the answer that we have selected here is K and L. You have to buy and you have to sell M. That's what it will be the answer. So we have completed this question also. I hope you could get this. If not, then please send me an email, right? To get this clarified. My email ID is healthofmywealth@gmail.com. So let us move to the next question, which is an investor deposits 300 lakhs today with a fund manager for a period of 5 years and gives a mandate that at any cost there should not be any erosion in this initial wealth by the end of the 5 years. So that's what he has said. If the current risk-free rate of return is 8%, what amounts can be invested by the fund manager in the risk-free and the risky asset if the organization limits the leverage multiplier to a maximum of 2? So it's very simple. What we have already solved, you have to first find the PV, which is to be found as 300 upon 1.08 raised to 5. Okay, so that would work out to be this much. Okay, now what you have to do is that fund manager, since the PV comes out to be 204.175, the fund manager can invest the difference between the two value, which is portfolio value and floor value, which is what we have already discussed. So this 300 is your portfolio value, 204.75 is your floor value. So this minus this into 2, which is your multiplier. So you will have 191.66 as the investments in risky and 108.34 as the investment in risk free. So we have, since we are being asked what is risk free and what is risky, then we go ahead with this particular answer, 108.34 and 191.66. Move on to question 12, which is again a theory. Which of the following statement is not true? Different assets involve different cost of transaction. That's a statement which is absolutely true. In real estate, you will pay higher cost of transaction compared to equity. International equity has higher transaction than domestic equity, which is also true because there is a foreign exchange cost. Listed equity pose more complications in rebalancing than illiquid assets. No, this is not correct. Listed equity will not pose complication. You can buy and sell them much frequently. Question number 13, which is a fill in the blank, is the process of aligning portfolio weights to strategic asset allocation. It is an important step in portfolio management process. I'm sure all of you know by now that it is nothing but a rebalancing, and that is what we are discussing in this entire video. Rebalancing is the process of aligning portfolio weights to strategic asset allocation. We quickly move on to question 14. I have not spent much time here because it's more of a formula. Which of the following defines investment in risky asset as per CPPI? So the formula is straightforward, which we have discussed many times in this video, is portfolio value minus floor value into M multiplied by M. M is the multiplier that you want to, or the leverage that you want to do. Question number 15. Under the following rebalancing strategy, the portfolio value becomes a function of performance of risky assets, and there would be no limit on the upside potential. So this is an investment strategy which is buy and hold, because once you buy and keep the investment with you, whatever is the risk-free investments, there is a defined line of where it will go, but risky assets can grow really fast. So buy and hold would be the strategy. Buy and hold strategy ensures that your upside potential can be unlimited. This takes us to the last question. Which of the following is not true about buy and hold strategy? So we have discussed a lot about buy and hold strategy, but here just a quick question. Buy and hold strategy reduces the cost of transaction. Absolutely correct. The portfolio value becomes a function of performance of risky assets, and there would be no limit to the upside potential, which is also correct, right? Buy and hold strategy is the most effective for market risk management. No, it's a passive strategy, so it cannot be effective for market risk management. So we go ahead with the option C, but let us also understand option D. In this kind of strategy, the asset mix drifts significantly over a period of time from what was originally thought. Yes, it is true, because when you started, you have allocated your assets into, say, your investments into 10 different assets. Now the value of each one of them have changed differently, and because of which your asset mix has drifted, because you are not changing your portfolio. Remember, this is a buy and hold strategy where the portfolio churning does not happen. So as I said in the beginning, we have completed 16 questions, 3 or 4 numericals. I'm sure this video will help you. Please do refer this channel to your friends, those who are preparing for NISM or IIBF exam. Like this channel, like this video, and subscribe to this channel. Thank you for your time.